Hello again. I'm here with Christoph Broja, who is a partner in EQT's Life Sciences team. Good morning, Christoph. Please introduce yourself and your firm.
Yeah, my name is Christoph Broja. I'm, as you said, a partner in the Life Sciences group of EQT. I'm based in Munich. We're a group of about 30 investment professionals focused on investing in biotechnology and medical technologies across early stage and late stage. So think venture and growth. We're really, you can think of us as a team of specialists within the broader EQT platform. We have 22 PhDs within our team, have been doing this for over 30 years, underwriting early stage and late stage risk. And we're really helping companies to transform science into real products with commercial potential that bring real benefits to patients.
I think life sciences is still a little bit niche in the private equity context. It's not a strategy that many firms adopt because it's very specialist and you need to have PhD people working for you. So why do you think investors should look at life sciences more? Why does it matter?
I think the term niche is maybe a bit of a misconception. I think it's actually core for every portfolio because it's one of the growth drivers of the next decades to come. There are a few converging trends that really make this a very attractive growth opportunity over the decades to come. Starting with aging. In 2050, the number of 60-year-olds and above will double. Age is a risk factor in many diseases, so the demand for new therapies to treat chronic diseases will increase. Secondly, we still have vast unmet need despite a lot of progress that has been made over the past decades in a lot of disease areas. If you think about cancer treatments, for example, companies are still pushing the boundaries of what's possible. Thirdly, there is something called the patent cliff. About $300 billion, that's about 40% of pharmaceutical revenue is going to come off patent by the end of this decade. That's an enormous number, and that number will have to be replaced by investing in innovation. So pharma companies are very interested to acquire venture-backed private companies like the ones that we back. So from an investor perspective, it's really growing demand and increasing set of tools that is at our availability by innovative companies and pharma companies that need to deploy massive amounts of capital, which will result in liquidity for investors.
So you would describe the market environment currently as quite buoyant?
I think we've seen sort of a full cycle in a relatively contracted time frame. You're right. At the moment, we see a lot of positive signals from the market. On the one hand, public markets are back. Post-COVID, we had a massive correction sort of in the 2021, 2020 time frame. Right now, the environment is a lot more constructive. Public biotechs have actually outperformed broader indices in the last 3 quarters. It's not AI, it's not infra, it's actually clinical stage biotech. And that gives investors confidence that there's money to be made in this sector, and that bodes well for IPOs in the next sort of 12 to 18 months.
So that's a real improvement compared to a couple of years ago.
That's exactly right, yes. And at the same time, I would say private company valuations are still very moderate. And the focus now is really on focusing more on fewer companies, raising larger amounts of capital, building larger pipelines with higher quality science and higher quality teams. So really from an investor perspective, again, it's a much more healthy setup today than it was 5 years ago and bodes well for the years to come.
I think some people see life science, especially biotech, as a little bit risky maybe. How do you manage risk when investing? How do you reassure your LPs?
Yeah, I think that too can be somewhat of a misconception. I think where it all starts is by knowing the risk that you underwrite. And that's exactly what we need these 22 PhDs for. We need to understand the products and the science in detail, but also the commercial applications and the exit routes that these companies have at their availability. So that is the number one prerequisite. You have to have the right set of specialists making these investment calls. And then at a portfolio level, we can manage risks through 3 avenues. One is what I call balanced diversification. So on the one hand, we diversify by not investing in the same biology, for example, investing behind the same biological targets, especially when they're not validated yet. But on the other hand, as I was saying, we're concentrating bets behind fewer, higher quality companies. So it's really a balanced diversification. Secondly, we can manage risk with deal structures. For example, we tranche in capital as companies hit their milestones in terms of clinical or regulatory milestones. So instead of putting all the capital at risk at once, we have a much more measured way to fund companies. And then thirdly, it's loss control, right? I think we have a loss ratio that is vastly below the industry, roughly half, which shows you can manage risk if you do the right things, if you pick the right companies, because it's equally as important to avoid big losses than it is to double down on the winners in your portfolio.
What are the current themes in your space, and what do you think are the themes that are going to dominate over the next decades?
Yes. Number of themes, I think three to highlight is focus on large markets, especially also in chronic diseases. I'm just back from JP Morgan, where a large pharma company told me 2 billion is the new 1 billion, referring to sort of the peak sales potential that they are looking at when they are acquiring companies. And you can achieve this really in two ways. Either you focus on vast markets like obesity with measured prices, but very large patient populations, or you focus on devastating diseases where there's really not much available and where pricing power is still very strong. That's one big theme, large market potential. Another theme is continuing acceleration of science. I spoke about acceleration in the past 2 decades, and we're seeing that now as well. And the two drivers are new AI tools that are deployed in AI drug discovery, making drug development times shorter and more efficient. And that's now happening also at a global stage. Especially China has stepped onto the innovation train and is coming with really novel science to the Western markets. And that behooves us to accelerate innovation. And a lot of companies are realizing that they have to do that more efficiently and focus really on big commercial opportunities. And then I think those are two main trends. I think maybe just to add one, focus on validated technologies rather than moonshots. What I mean by that is there's a handful of technologies like antibody drug conjugates, bispecific antibodies, peptide-based drugs that are still nascent, but already have shown some clinical and even commercial progress. And this is really where a lot of capital will be deployed rather than sort of pie in the sky type of opportunities.
Thank you, Christoph. Super interesting. Thank you for your time today.
Thank you, David.